Why do some investors look at the exact same opportunity, the same numbers, the same brand, and come to completely different conclusions? One leans in, the other passes, and over time, one compounds capital while the other just keeps searching for the right deal. It's not because one is smarter or has better access. It's because they're evaluating the same opportunity through a different lens. I'm Justin Kaiser, CEO of Empire Franchising, and I've spent the last 25 years building, scaling, and investing in businesses, including taking my own franchise brand from 0 to over 100 franchise territories in 3 years before an acquisition at the end of 2024. Most investors are trained to look at snapshots, revenue today, margins today, growth over the last 12 months. And while that matters, it doesn't tell you how the business actually behaves when you introduce capital into it. Because the real question isn't what this business has done. It's what happens when you try to scale it. Can it absorb capital? Can it deploy it efficiently? Can it do it repeatedly without breaking? Because that separates a good business from a scalable investment. This is where franchising becomes interesting, because not every franchise is a good investment. But because the model itself, when structured correctly, is built for replication, it's built for expansion. It's built to take a working system and apply it across markets. But here's what most people miss. Replication alone doesn't create value. Controlled replication does. Because if every new unit requires new thinking, new processes, new problem solving, you don't have a system. You have a series of one-off outcomes. And one-off outcomes don't scale. They fizzle out. So the investors who consistently win in this space aren't just asking, does this concept work? They're asking, how tight is the system behind it? How consistent are the unit economics? How predictable is the path from lead to open location? How much variation exists between locations? Because variation is where inefficiency hides. And inefficiency is what slows down returns. Now, layer in something even more important. What happens when you increase volume? Because a lot of businesses look good at small scale, a handful of units, limited exposure. But when you start pushing, when you increase the lead flow, when you try to sell more territories, when you onboard more operators, that's when the system gets tested. And that's where you find out whether it was built to scale or just built to work. That distinction matters in what most people think, because investors don't get paid on what works at a small scale. They get paid on what holds up at scale. Now, take that one step further. Let's look at how infrastructure plays into this, because infrastructure is what determines whether growth creates leverage or complexity. If marketing, sales, onboarding, and support are all fragmented, then growth adds friction. Things slow down. Margins get squeezed. But when those functions are centralized, refined, and repeatable, growth starts to create efficiency. And efficiency is what drives better outcomes over time. This is why investors who understand franchising don't just evaluate the brand. They evaluate the system's ability to handle volume. Because volume exposes everything. It exposes weak unit economics. It exposes inconsistent messaging. It exposes gaps in support, and it also exposes strong systems, the ones that get better as they scale. Now, here's where the real opportunity shows up. When you take a system that works, and instead of applying it to one brand, you apply it across multiple brands inside a platform, now you're not just scaling units, you're scaling the infrastructure itself. And every new brand that plugs into that platform doesn't reset the process, it strengthens it. It adds data, it refines execution, it improves efficiency, and over time, that creates a completely different type of asset, not just a business, but a system that can repeatably turn capital into growth. And that's what sophisticated investors are actually looking for, not just upside, but repeatability, because repeatability reduces risk. And when risk comes down, capital becomes more aggressive, and that's when outcomes start to separate. So if you're evaluating franchise opportunities right now or looking where to deploy capital, don't just ask whether the business works. Ask whether the system can handle scale without friction. Ask whether it can handle volume. Ask whether it improves as it grows, because those are the indicators that determine whether you're stepping into something that can compound or something that will just require constant input just to maintain. If you understand that difference, you stop chasing deals and you start recognizing systems. That's where the real advantage is.